Hello and welcome to Business Today Television. I'm Siddharth Zarabi and you're watching Easynomics. On today's show, joining me, Rajani Sinha, Chief Economist at Care Ratings, and Mitali Nikore, Founder and Economist at Nikore Associates. Thank you very much, Mitali and Rajani, for joining us. We are counting down to the release of the second quarter GDP numbers, and these numbers are going to come in the next 5 odd minutes, so we are on standby. Those numbers will flash on your screen. But before we do that, in terms of the expectations, there have been a range of forecasts and expectations. If you look at the numbers, IDFC at 6.1%, and you can see GDP trend, that number was flashing. SBI at 5.8%, IDFC First at 6.1%, Deutsche Bank 6.2%, Kotak Mahindra Bank 6.2%, HDFC Bank 6.3%, Yes Bank 6.9%. Goldman Sachs had also revised it downwards. So had Moody's and so had S&P Global. Those numbers on the screen. Again, I'm going to go to Rajani first for a quick take before we get the numbers. Rajani, what estimate are you working with?
So, Siddharth, we are looking at 6.2%, and we are mainly basing this on expectation of good growth in service sector. Service sector, if I look at specifically at the component of transport and communication, trade, hotel, transport and communication, that particular component, what we saw in Q1, it had shown a contraction of around 15% compared to the pre-COVID period. And that came as a surprise to us. And we're expecting this segment to revive based on pent up demand and opening up of the economy. As far as the manufacturing sector is concerned, we feel that there'll be some benefit of demand improving in the economy, but the manufacturing sector has struggled in this quarter with high commodity prices and lower external demand. So those factors will impact the manufacturing sector.
Okay. Mitali, the same question to you. What numbers are you working with? And we are now counting down. Perhaps in the next 2 odd minutes, we'll have the headline number. Mitali, that question was for you. Can you hear me?
Yeah, hi Siddharth. Sorry, I was just getting another call from from the ministry to talk about the numbers. So I was just finishing that. But I think when we look at the estimates and the projections at this point, we have to also take into account the expectations from various international organizations that are coming through. So there are some international organizations like ADB and World Bank which have actually placed the estimates a little bit higher than what we are talking about, where we are talking in the range of 6.1. But if you look at ADB World Bank estimates, they are talking in the range of 6.8, 6.9, and even up to 7.
Okay.
So I think, it will be interesting to see where we finally land and, what the numbers actually turn out to be. I think we're all quite excited to see that now.
Okay. Let's bring up the GDP trend chart, Q2 of FY of the previous financial year. If you can bring that up on screen just to see. That was a reading of 8.4%, October-December quarter 5.4%, January-March 4.1%, April-June 2020, and that's the bounce back. And the number that we are waiting for, the question mark. In terms of 2 key features to look out for in today's number, the first number that everyone's keeping a close eye on, or rather the derivative would be, is the recovery sustainable? I come to you, Rajani, in terms of your assessment of what will the broader picture these numbers provide, more in a look back sense, and going forward in terms of sustaining the recent revival.
So you just showed the GDP growth trend. And the important point to note in that is that in the first quarter, while we saw 13.5% growth on YOY basis, if we look at it sequentially on a Q on Q basis, there was a contraction. And that was a cause of concern. And in fact, the first quarter number on YOY basis was lower than market expectations. But we feel the second quarter number on a sequential basis, we are going to see an improvement. And going forward also on a sequential basis, I will not talk about YOY because YOY will be impacted by base effect. And we do see going forward GDP growth in the third and fourth quarter coming to around more than 4% or so. But that's mainly because of base effect. But otherwise, we are expecting the sequential momentum to be maintained and we are expecting it to improve going forward. And if we look at the high frequency indicators also, we are seeing improvement in many of the indicators. Though some of the indicators like say IIP, consumer goods and durables as well as non-durables are still looking weak. But broadly, if I look at the high frequency indicators, they are also showing revival. The cause of concern would be what happens on the export front. Because even in the first quarter, we saw that the net exports was a big factor which kind of, shaved off from the GDP. And this is something which is going to happen in the second quarter also and in the quarters going forward too. So what happens on the external front, I'm worried about that. And that's something which I would be watching out for.
Mitali, how important is a factor at this stage in terms of domestic demand? We know the external environment is skittish. We've seen what's happened from last year with Ukraine. How important is domestic demand to continue to drive our growth?
So I think Siddharth at this
Okay,
point,
breaking news number, the July-September GDP growth number at 6.3%. Let's bring that up. 6.3% is the latest reading, and if you look at it in terms of the forecast, this is the big breaking news here on BTTV at this stage. 6.3% is the second quarter reading for GDP, and that's the big number, 6.3%. I would say in line with consensus estimates. HDFC Bank had pegged 6.3% and slightly above, in fact 50 basis points above State Bank of India's projection. But in terms of the trend graph, let's try and get that back up as quickly as we can. And I'm going to give you some of these numbers. July-September GDP growth at 6.3% versus 8.4% a year ago. So a significant decline, 210 basis points. The average of polls, including by Informist, had pegged it at 6.3%. GVA growth at 5.6% versus 8.3% a year ago. Nominal GDP growth of 16.2% versus 19% a year ago. Farm sector growth, and now we are getting some of the granular data that we'll try and bring up on the screen. Farm sector growth at 4.6% versus 3.2%. So absorb that number, Rajani and Mitali. I'll come back to you very quickly on that. We are basically seeing a good farm sector growth. Construction sector growth at 6.6% versus 8.1% a year ago. Again, a decline. There was a pent-up demand that's kind of has gotten exhausted. It will be interesting to see this number for the subsequent quarter when it comes. Manufacturing sector growth at minus 4.3%. That's the big number that we can talk about at this stage. Minus 4.3% versus 5.6% a year ago. So look at manufacturing at one side of the swing and look at farm sector. These key mining sector growth, I have that number also here with me, minus 2.8% versus 14.5%. Those numbers many of you, our viewers, would be tracking very, very closely. But I'll quickly recap. Construction, 6.6%, a decline there. Manufacturing, a steep decline. Mining, a very, very steep decline. Farm sector growth, positive, better than the same period last year. Overall GDP down well over 210 basis points. And in 6.3%, I think a lot of the expectations seem to have been met. I come to both of you. Rajani, starting with you for a quick view on these numbers as you heard them.
So GDP growth of 6.3%, as you said, is very much in line with market expectations and our expectations. And while, the number looks lower when you compare it to what we had in the corresponding period of the previous year, but if you look at it on a sequential basis, this would be an improvement of more than 2%, which is a positive aspect. But yes, what is very concerning to me is what you spoke about manufacturing sector contracting by 4.3%. This comes as a surprise to me.
I'm interrupting you here because I have more numbers. July-September services growth at 9.3%, and we are seeing the April-September, the half-year GDP growth number that's at 9.7% versus 13.7%, and GVA growth also trending more or less similarly. I just wanted to add the services component. Please complete your point, Rajni.
Yes. So I was expecting that services growth would have been much higher than what we were expecting, given that manufacturing has contracted by more than 4%. So manufacturing, like I mentioned, we were concerned about high commodity prices and lower external demand, but I wasn't expecting this kind of contraction. So definitely this is a big cause of concern.
And what
Services,
about mining? What about mining? A quick view on mining.
so I missed the number. What did you say about
Oh,
mining?
okay, I'll give you that number. Mining sector growth at minus 2.8% versus 14.5% a year ago. Now you can discount 14.5 because post COVID sort of restart of so much, but negative at a time when we would see. So would it be fair to correlate mining and manufacturing basically the higher end of the productivity cycle suffering, while as farm and agriculture sector catering to a much wider base performing better? Is that the way to look at it?
So definitely, it looks like whole of industrial sector, mining and manufacturing has been severely hit. But the very positive aspect is this very strong jump in service sector that we have seen. And
Yes.
though right now we have not looked at the breakup, but as I had mentioned earlier, I feel it could be because of this component of trade, hotel, transport, and communication doing much better than what was expected, because we had seen a strong contraction in that in the last quarter compared to the pre-COVID period. So we
So,
were
Mitali, I'm coming to you. Rajni, I'll come back. Would it be fair to assess these headline numbers at this stage? Rajni made the point about granularity. We are also trying to get those numbers. Would it be fair to say that the consumption side of the Indian economy is robust, kicking, choose your phrase as you like it, but the core manufacturing industrial side is suffering because perhaps the pent up stuff has run out of steam and the export side is going down, and that larger sort of capital led investment is therefore showing up in these numbers? Would it be a fair assessment?
So I think, Siddharth, let's just back up a little bit, to where we were discussing about the domestic demand. And that is exactly the story that came out, just a minute later as we were discussing it in the actual numbers.
Yeah.
The entire world is currently looking at India as a bright spot. We are actually seeing that this is one of the few economies globally where, despite high inflation levels, you're still seeing an increase in consumption demand. So that story continues to be strong. And the strong growth in the agriculture sector shows that it's not only urban demand, but there's a strong growth even in the rural centers that's coming
Is that
in.
so, Mitali? Is that so, or is it just the fact that we didn't see too much weather-related disruption? Is it just a factor of productivity rather than demand? Because a lot of the production would head into warehouses, the MSP-driven stuff. Why would you link it to rural demand, which anecdotal data and other kind of data suggests has been suffering a bit?
So I think, Siddharth, to some extent, there's also government consumption spending that has to be credited for this. The government spending happened in the right areas. It happened for social protection during COVID, which resulted in a situation where during COVID, you didn't see households suffer as much as they would have without the government support.
Okay.
So when have the free cylinder scheme, when you have, the food grain scheme, then you have a buffer, you have a social safety net that was actually given to a lot of rural households. So
Okay.
you do see that, this new consumption growth that's starting to come, this, reversing of the trend post-COVID, that is actually panning out pan-India, not just in a urban, it's not just an urban story. But the
Okay.
manufacturing sector growth decelerating despite the production-linked incentive schemes having been launched in over 17, 18 sectors.
Hold on. I now have more granular data. July, September, government consumption growth is minus 4.4%. Rajni, this data is giving us some more. Capital formation growth at 10.4%, but the government part of it is negative 4.4%, and private final consumption growth at 9.7%. But before you respond to that number, Rajni, I just want to back up on this point. Would it be fair to argue that the agriculture part of the economy is more dependent on weather gods, and of course states and center doing their bit for our farmer, but that is not truly reflective of the real state of the economy? Industry, consumption, and government's own data that we just spoke about suggesting that things are not fully in balance, Rajni.
Because even if you look, we are getting very mixed indicators. So even right now,
Rajni, we are apologies for that, but the network at your end seems to be coming in the way. Let me go back to this to Mitali once and wait for 10 seconds for Rajni. Rajni, do you want to give it a shot again? Maybe we can hear you better now. Just go ahead once, otherwise I'll go back to Mitali.
yeah, what I was saying is that definitely things are not completely balanced. Consumption is a cause of concern. And on consumption, we are getting very mixed signals. So if I just look at the first quarter GDP number, I'll have to look more closely at the second quarter GDP number. But even the first quarter GDP number, we had seen that consumption, when compared to the pre-pandemic period, had recorded a good growth of 10%. Which is pretty good. I'm talking about pre-pandemic period, so removing all the base effect. And then a lot of other indicators of consumption like auto sales, GST collection, they have all been recording very robust growth. But like I mentioned earlier, there are some other indicators like IIP, consumer durables as well as non-durables, which are not very good. We have had FMCG companies highlighting that the rural demand is still weak. So yes, there are very mixed indicators coming on the consumption front. And another point to note is that if the manufacturing sector is contracting, that also speaks about consumption. So it's kind of very surprising that if the consumption GDP is showing a growth, private final consumption expenditure, then why would the manufacturing sector record such a sharp contraction? So definitely all is not balanced, and consumption cannot be very strong if manufacturing sector is recording a contraction on a IOI basis.
Rajni, just that point about government consumption growth, I'm not very clear about it. Is this a data aberration, or is it the fact that the budgetary year spending did not come through in the second quarter? I'm a little perplexed at this number, frankly.
So I am not sure what would have happened, because if we look at government finances, from there we are seeing that government expenditure is happening and is on track, as the revenue expenditure as well as capital expenditure.
Okay.
So the GDP data not reflecting that, we'll have to go deeper into that to see what exactly has happened.
Mitali, I come to you, and before you respond to this point that we are discussing, just one more bit of data, and I'll request my producers to get it up on screen. October tax mop-up has risen to 20.8% year on year, and the April-October number is up 18%. So we are discussing this on the cusp of really the fourth quarter, just one more month for the fourth quarter to start. And you saw gross tax revenues at 17.6%. That number has improved now. We can update that later on to 18%. So Mitali, again, the question of where is our recovery now headed Last year, if I had been discussing with you, the COVID was pretty much the word after every 3 words in any such conversation. And then we had Ukraine. If we now look forward with this data, what is it telling you? And more importantly, I'll come to Rajni also on that point, but Mitali, to you first, what needs to be done in the remaining 3-4 months of the year to ensure that growth doesn't dip further?
So I think, Siddharth, firstly on the on the question that we are discussing with respect to government spending and why it may not be reflecting, one simple reason could be that it's an accounting issue, as we are discussing quarterly numbers and not annual numbers. So we may
Okay.
have a high amount of government spending happened maybe 1 quarter ago, and therefore in this quarter it has not grown. So and then again maybe next quarter the disbursements will increase. Typically in the last quarter the government spending disbursements are the highest. So it may just be a flow issue rather than a stock issue, because we know that a lot of the budget spending for the year has already taken place. So
Okay. Just
that's
hold on, Mitali. I just want to add some more color to the point that we are adding. The Finance Minister Nirmala Sitharaman was at a news agency Reuters at an event earlier, and they have put out some lines. And relevant to this, although we'll get to hear the government side of things at 6:30 p.m. And please do tune into Business Today television to catch the Chief Economic Advisor's briefing live on BTTV. The Finance Minister earlier today had said, confident that GDP numbers will be on expected lines. They obviously have access to the data much before commoners like us. And growth numbers unclear due to exogenous factors. Now, I don't know if she used this word or if this is a smart journalism at work. And then she has said government's focus is on growth. States have shown extraordinary capacity to absorb money. The point about government expenditure, and just for some color, India's GDP is not produced at the center. The center is just a few union territories in some ways. It's produced in the states. And she has also then gone on to say that high inflation is going to persist, fairly comfortable with farm supplies, but she's also said inflation to be in tolerance range by early FY24. And then there are more comments about various other matters, including the rupee and oil, but she's ended, at least this copy has ended by saying that macroeconomic fundamentals are absolutely strong. I interrupted you, Mitali, just to add this flavor to it. Please continue your point before I go to Rajni.
Thanks, Siddharth. So I think this is exactly what we were discussing, that these exogenous factors that you just mentioned, they are actually these global headwinds that to some extent the government of India cannot control. When we talk about imported inflation, when we talk about the war in Ukraine and Russia, these are leading to global catalytic effects that are coming, and that they are creating higher and higher inflationary pressures. The government is currently managing them with a subsidy regime.
Do you think inflation has peaked in the Indian context?
Sorry?
Has inflation peaked in India?
That should be a topic for a different show.
Okay. Rajni, I want to come to you on that. Rajni, I'm coming to you on that, and not on the inflation comment, but again to continue the debate. What kind of growth have we witnessed in the past quarter now that we have had some more time to absorb these numbers?
So, in the first quarter, like we discussed, we had 13.5% growth, but on a sequential basis, growth has actually fallen. So now, this quarter, the number that we have had, 6.3%, would have seen a sequential improvement. And going forward, we are expecting around more than 4% growth, around 4 to 5% growth number we have for the third and fourth quarter to be.
So Rajni, I'm interrupting you. Did you say 4 for third quarter and 5 for fourth quarter, or between 4 to 5?
I'll give you the exact number. third quarter we have projected 4.6% and fourth quarter 4.4%.
4.6 and 4.4. And if I may ask you, why is that? Because the third quarter is the Diwali quarter. And as far as consumption is concerned, services is concerned, and I guess farm sector also, they've all done fantastically well. I mean, if you went out in the pre-Diwali 30-day period, the markets were full. People were buying even at the elevated prices for every single product. So why would you be sort of conservative with your forecasts
So,
at 4.6?
this is just statistical impact of the base effect. Actually, on a sequential basis, quarter on quarter basis, we are expecting growth to improve in the third and fourth quarter. So you're
Okay.
very correct in that sense that we did see a very healthy and robust demand during the festive season of third quarter. So even though while I'm saying 4.6% in the third quarter and 4.9%, it's on a YOY basis taking into, so it's not really that I'm saying that growth, statistically it is, growth is decelerating, but actually the momentum is going to improve in fact going forward. And
Okay.
actually, the big concern that I would talk about right now, which I am most concerned about, would be what's happening on the external sector front, because that will also have not just impact through exports, but also this whole uncertainty about what's going to happen to commodity prices going forward. Because right now, the big respite that we have got is from fallen commodity prices that have happened in the last few months. But things being so uncertain on the global front, I would be concerned about what's going to happen on that front. With whole global slowdown, I would be concerned about, what kind of capital inflows will I get going forward. And
Okay.
given that CAD is already widening and we could see lower capital inflows, the balance of payment is likely to move to the deficit zone in FY23. And then the whole concern around fiscal deficit.
And you are saying this, Rajni, despite the recent encouraging trend in terms of flows into the capital markets and perhaps continuing FDI numbers as well.
So FDI numbers have been healthy, but FII numbers have been very volatile. So yes, in November we have seen strong FII inflows, but in October there was a contraction.
What
For
about
all the
inflation? What about inflation? I'm sorry I'm interrupting you, but what about inflation? There is one view that one gets to read and hear from the international side that inflation may be at a peak, at least because of all the shock factors, including the biggest element of the energy induced inflationary shock. That seems to have been controlled. The United States is put in an inflation control act, unprecedented stuff. So maybe by the time we are in the new year, we will have better tidings as far as global inflation is concerned and its pass through to India.
So very quickly, I'll talk about global inflation and domestic inflation. So on the global inflation front, yes, the data that we have got from US has shown some deceleration in inflation, and that comes as a comfort, and hence the whole expectation that probably Fed could also moderate the rate hikes going forward. But at the same time, the last data that we have got from EU and UK has shown further increase in inflation. But yes, the big comforting factor is that if I look at the whole of commodity index, the commodity prices all across have been coming down, including metal prices, energy, and food globally. So that's a big comforting factor. But the
Okay.
concern is that this inflation has actually really seeped in, and core inflation is higher all across, not just in India but globally. So that's the big cause of concern. And core inflation is something which is very difficult to recede once it goes to a high level. So even for India, while there's big comfort that inflation has gone below 7% and we are expecting overall CPI inflation. So for India, CPI inflation, we have peaked. And now we're expecting it to go down in the coming months. And by the end of the fiscal year, we're expecting it to go below 6%, as
Okay.
RBI has forecasted. But the concern is core inflation, which is still above 6%. And
That
also food inflation, which is still high. And this high food inflation will put pressure on inflationary expectations. So household inflationary expectations, the last data point shows it has jumped up to around 10%. So
Okay.
this would be a cause of concern, and hence RBI would continue to remain vigilant going forward, even though definitely there is reprieve on inflation front.
In fact, since we are talking about the RBI, just to add, the RBI also got it right. I think their number was 6.3% when it comes to
Yeah.
GDP, and viewers, absolute numbers are sometimes difficult to absorb, but the absolute number for the second quarter is at 38.17 lakh crore, and this compares with 35.89 lakh crore, and that's where the growth of 6.3% comes from. Mitali, you want to add to the future possibilities? Rajani has given us her numbers. Are there any numbers that you are working with for the remaining part of the year?
So I think, Siddharth, we've got some great numbers from Rajni and from the government today. So I don't want to add to that confusion, but I do want to talk about the real economy and some of the core factors that Rajni talked about, and core inflation per se. What is actually driving these trends? At the core of it, when we look at oil prices, when we look at imported inflation, that is creating a scenario where the government is artificially kind of managing these prices with the subsidy regime. So that is obviously going to have fiscal implications, and it doesn't mean that we are going to reach a point where we may not have seen the peak of inflations at this point in time, because we have to see how global economies like the UK, like Europe, are actually going to be able to manage their energy prices. And I think that going forward as an economy, we need to diversify our fuel sources. We need to see more and more investments coming into clean energy. We need to see more investments coming into the manufacturing sector. And the dismal performance of the manufacturing sector, despite the production linked incentive schemes, is definitely a cause for concern. It shows that at this point in time, the government needs to be investigating which production linked incentive schemes are doing well,
Right.
and increase the spending on those.
Right. In fact, as we close the show, just want to add some more perspective and then take very quick closing comments. Another way to look at this number would be normalization. We had a fantastic sort of base for the first quarter, and that is now clearly behind us. What we are also seeing is normalization plus, Rajni, and that is a point that I want to address with you as we quickly wrap down the show, which is the impact of the monetary policy hikes. The number is 190 basis points from May itself, and perhaps one more hike coming very soon. So that is also something that we should factor in as far as the numbers are concerned, because 6.3% versus the overall median estimate, if we were to sort of do a median of all the major polls, was around 6.4%. So not terribly off. How would you respond to those 2 points that we just made?
Hike by RBI in the December meeting, but we are expecting the rate hike to moderate to around 35 basis point as against 50 basis point that we have seen in the past. And yes, I agree with you that we will, there is some impact of monetary policy tightening that has happened so far. And in fact, more of the impact we'll see going forward, because monetary policy takes few quarters for the impact to be seen. And in fact, the transmission has not happened fully. If I look at the increase in deposit rates that have happened so far, while the lending rates which are linked to EBLR has gone up, the deposit rates have still not gone up to that extent to reflect fully the rate hike, the policy rate hike that has happened so
Okay.
far.
Okay.
Uh,
Very
so,
quickly, Rajni, very quickly, what's your full year number now that you have the Q2 numbers before you?
so we are expecting GDP growth in the range of 6.8 to 7% for the full year.
And for you, Mitali, what's the full year number you are considering?
I think it's about 7 to 7.2 for the full year.
Okay, and that's the word from two economists on our show, and it's very clear. Going forward, and the key relevant elements would be the direction of monetary policy and whether the MPC mandarins feel that the rate hikes that have been put in so far are enough. Rajni spoke about 35 basis points, which is pretty much what every economist is talking about, and I would be the lone ranger to suggest that maybe it might be time to pause, but there's a view on that could be held on to later perhaps after the budget. And depending on where you stand in the markets, could be a speed breaker or could provide further directional momentum. But the big macro number at this point of time, 6.3%, and the breakup telling us that the recovery that we are seeing will have to be nurtured both on the fiscal side and the monetary side, and hopefully inflation will no longer be that big a concern and inflationary expectations will further mute from here on. I think that's what would be the best way to look forward as far as India's growth is concerned. Rajni and Mitali, thank you very much for your time and patience with us on the show. And you, the viewer, if you've been, thank you very much for watching. We'll be back with more. It's a wrap on Easynomics for now. Goodbye.